Welcome back. Let's be real, something about SCHD just feels off right now, doesn't it? For years, it's been touted as the gold standard for retirement investing, the ETF you could hold with your eyes closed, the one asset that promised reliability and steady dividends without drama. But suddenly, there's a storm of chatter online. People are panicking, saying SCHD has lost its luster, that it's no longer the dependable, set it and forget it investment it once was. And here's the part nobody seems to highlight. What if all that fear is completely misplaced? What if the assumptions people are making are based on surface-level observation rather than understanding the engine underneath? And what if selling SCHD right now is exactly the kind of move that could haunt you for the next decade? Because the truth is, the real story behind SCHD isn't what anyone expects, and the question you need to ask yourself isn't whether it's exciting or flashy. It's whether it's doing its job as the retirement anchor it was designed to be. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. Right now, if you own SCHD, I know the feeling. You check your brokerage account after another dividend payment hits, and yet your position barely budges. Meanwhile, everything else, tech stocks, growth ETFs, whatever's trending, seems to be climbing relentlessly. You bought SCHD because it was the responsible, rational choice, a dividend powerhouse that promised stability and income. For a while, it delivered. 2021 felt incredible. Then came 2022, 2023, 2024, and now we're in 2025, and your SCHD investment looks almost identical to where it was 4 years ago. Dividends are steady, yes, but the price is essentially flat. Meanwhile, colleagues and friends who chased high-growth plays are celebrating massive returns, making your reliable dividend pick feel almost boring. It's natural to start second-guessing, to Google, watch videos, and read headlines. Everyone seems to have an opinion. Rotate out, chase growth, admit SCHD's glory days are behind it. Confusion sets in, frustration grows. But here's the key insight. Most of that panic has nothing to do with SCHD itself. It's about how we respond to uncertainty and how short-term fear distorts long-term judgment. The mistake most investors make is comparing apples to oranges. When you bought SCHD, you weren't buying the next NVIDIA or a hyper-growth tech rocket. You weren't trying to quintuple your money in a few years. You were buying stability, cash flow, and peace of mind. SCHD's mandate has always been clear: high-quality, dividend-paying companies that deliver predictable returns. The problem is, our brains don't like slow, steady reliability. We see others outperform, and suddenly we feel like we're falling behind. But that's a trap. It's like expecting a dependable sedan to handle like a sports car. SCHD isn't broken. Your expectations are. Consider this. A stock or ETF that sits flat for years while others surge isn't a failure. It's often an opportunity. Value investors see stagnation not as disappointment, but as a chance to buy quality at discounted prices. Right now, SCHD might be at one of its lowest relative valuations in years. Yet instead of seeing opportunity, many are tempted to sell and chase assets that have already skyrocketed. That's not smart investing. Dividend investing isn't flashy. It's deliberate, slow, and predictable. It rarely goes viral because steady returns don't make headlines. But boring often wins. Boring means you sleep soundly during a crash. Boring means reliable income every quarter. Boring prevents devastating losses at the exact moment you need your portfolio most. Look at the downside protection SCHD provides. In 2022, during a tough market year, SCHD fell just about 5%. Compare that to Nasdaq's 30% plus decline or tech stocks dropping 60 to 80%. That's the difference between volatility-prone growth plays and a steady dividend machine. If you're close to or in retirement, which scenario makes more sense? Risking massive losses chasing upside or holding a vehicle that preserves capital while generating income? Younger investors with decades to recover can afford risk. Retirees cannot. And that's why SCHD exists. Not to double your money overnight, but to provide safety, consistent dividends, and long-term reliability when markets swing wildly. Another nuance is sequence of returns risk. When you're working and accumulating wealth, market dips are opportunities. When you're retired and selling shares for income, a 40–50% market drop forces you to sell more to maintain cash flow, potentially depleting your portfolio prematurely. SCHD mitigates that risk. Its focus on high-quality dividend payers ensures income continues, even during downturns, protecting you from being forced into unfavorable selling. People also underestimate the convenience SCHD offers. Constructing a dividend portfolio manually is hard. You'd need to screen hundreds of companies, track dividend sustainability, rebalance regularly, and replace underperformers. Most investors fail at this. SCHD solves it all. Around 100 vetted companies, automatic rebalancing, strict quality criteria, professional management, and an ultra-low expense ratio of 0.06%. Emotional decision-making? Eliminated. Systematic, disciplined, and hands-off, just as a retirement-focused ETF should be. Yet the frustration persists because SCHD isn't meant to be every investor's all-in bet. Diversification is essential. Think of your portfolio like a basketball team. SCHD is the defensive anchor, steady and reliable, preventing catastrophic losses. Growth stocks are your scorers, exciting but inconsistent. A proper mix balances stability and growth, tailored to your goals, risk tolerance, and timeline. Whether it's 30% SCHD with 50% broad market and 20% growth stocks, or 40% SCHD, 40% total market, and 20% bonds, the key is balance. Judged in isolation, SCHD may appear underwhelming. Judged for its role in your portfolio, it's performing exactly as intended. And don't forget the dividends, they're quietly growing. Companies within SCHD like Merck, AbbVie, and Pepsi continue to raise payouts, compounding income over time. This dividend growth combats inflation and strengthens purchasing power, turning a flat stock price into an increasingly valuable income stream. Over years, reinvested dividends grow exponentially, creating a reliable and growing cash flow essential in retirement. Stock prices fluctuate, but dividends are predictable and compounding. That's the beauty of dividend growth investing: dependable, sustainable, and aligned with long-term goals. In short, SCHD isn't broken. It's performing exactly what it was designed to do. It offers stability, downside protection, steady and growing dividends, and systematic management. It isn't flashy, but it shields you from catastrophic losses, builds income, and lets disciplined investors sleep at night. The temptation to chase growth or hype can be strong, but disciplined patience pays off. History repeatedly shows that investors who stick to a coherent strategy, resist emotional decisions, and focus on long-term objectives consistently outperform those chasing trends. SCHD may not make headlines, but for retirement-focused investors, it quietly delivers on its promise. So before you panic, ask yourself, am I judging SCHD by the right standards, or am I letting the noise of short-term excitement distort my view? The ETF hasn't failed. Expectations just need adjustment. Hold it, understand it, appreciate it, and let it do what it was meant to do. Provide income, stability, and peace of mind for decades to come. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell.